Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is December 9th, 2024, and today on our call, we have back the CEO, Aziz Rahimtoola, and the CFO, Sajid Premji from Sabio Holdings. Sabio trades on the TSX Venture Exchange under the symbol SBIO, and it also trades on the OTC under SABOF. The company is currently trading at 47 cents with about 50 million shares outstanding, or about a $23.5 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Aziz and Sajid, great to have you guys back. It's been a little while since we spoke last, so it's always good to get an update. You guys have come out with last set of numbers here with some pretty significant growth, so happy to find out what's happening and the reason for the growth. So why don't I just turn it over to you, and before we get into sort of updates, let's make sure everybody understands what Sabio is all about.
Thank you, Paul. It's great being here. Thank you, Paul and Trevor. It's Sajid and I always love an opportunity to talk to your audiences because they're usually pretty sophisticated and well-educated thanks to the work you're doing. So what does Sabio do? Sabio is in the ad-supported streaming space. And just to simplify it, those ads you see in mobile apps, sometimes display ads or streaming apps in your gaming apps, or the ads you see if you're watching Roku TV, we are one of the companies in the space that actually are serving those ads into that content. So that's really what we essentially do well. We work with brands and the agencies that represent them to help them reach audiences on those streaming apps, and that's really our business model as a whole. We're a profitable company. Oh, sorry, let's go back one, Aideen. We're a profitable company, 90% reoccurring business model. We work with the top global brands, some of which are showcased on the left side, and we're a leader in the ad-supported streaming space. And if you can imagine, no one's waking up and saying, man, I love my cable TV. Anyone under the age of 22 doesn't even know half of what the Canadian Broadcasting Network is, or half of the traditional TV players are out there. And what they're using is they're using ad support. They're using streaming apps to get their content, or they're using social apps. And so while we don't play in the social app space, we play in the streaming app space in a big way. And that's really what we're really capitalizing on. In terms of what is the market opportunity, it's a $45 billion market opportunity projected by 2027 and beyond. And so, this is really where we're in a unique position. We're this growing company in a growing industry with great margins that has a lot of technology behind it. And so that is what really makes Sabio unique, is the fact that we are, once again, in a high growth industry with a lot of potential and a lot of unique technology that not everyone has in the space that's in it today. We also, in terms of next slide, we work with some of the biggest brands because of that. The question I get asked a lot, Paul, is, Aziz, how do you work? How does Sabio work with a small company that has less than $24 million market cap, work with the likes of a Wells Fargo, a McDonald's? In fact, you could take a look at a press release we did, a joint press release we did with McDonald's. Go ahead and Google it. And the reason these brands are working with us is because we're addressing a need they have. First of all, they need to better understand the ad streaming audience. It's a younger, more fragmented ecosystem. They need to understand those audiences better. Number two, they need to reach them more effectively. And when you provide the combination of that, and number three, we also have a deeper understanding of diverse audiences. And so you combine the fact that they need to reach these audiences on streaming, they need to understand them better, and they need to understand diverse audiences. And the reason they need to understand diverse audiences is because close to 50% of all Gen Z, which is the ages of 12 to 24, close to 50% is now diverse in the United States and growing. And so they're faced with this challenge of trying to reach people on more fragmented media ecosystem, and streaming apps are taking off. They need to be able to understand those audiences, and the likes of Google doesn't give them any data or insights. Facebook or Instagram doesn't give them any kind of know-how or learning. And then the third part about it is they also need to understand diverse audiences, which none of those platforms actually have a deep understanding of. And that's why these brands are saying to us, we need your help. And we want to continue not only working with you, we want to work with you more. And that's exhibited by our reoccurring revenue model, which we'll get into later on in the call. And that really, I'm going to hand it over to Sajid Premji, our CFO, to talk about our business execution and what really is happening. Sajid?
Yeah. Thank you, Aziz. And as Aziz has talked about, 2023 has been a great year for us. And in Q3 was our best third quarter in our company's history. And it was the best quarter on the top line and the bottom line. And it was also our most profitable quarter in the history of our company. For the 3 months ended September 30th, we generated 16.1 million of sales, up 82% from the previous year of 8.9 million. And then that's a great number, but it really doesn't tell the whole story. And there was a lot of underlying strength here. The first was that it was the third straight quarter of double-digit growth in our CTV OTT business. So that's our connected TV, OTT, ad-supported streaming business. And ad-supported streaming grew 100% to a Q3 record of 12.3 million, compared to 6.1 million US in the same period last year. And all these figures that I'm talking about here are US dollars. And taking a step back, ad-supported streaming as a whole is very lucrative because it's the one segment of digital advertising that's still growing by double digits. And so, we're not only riding the trend of a growing industry, but we're outpacing that trend. The average industry rate is growing at 16%, and our 100% growth far outpaces that. And now, not only is ad-supported streaming a really fast grower, but it's also a lot more efficient than other brands of advertising, other streams of advertising. They carry larger deal sizes, they're operationally easier to perform, and they boast higher customer retention rates. And when you look at our recurring revenue rates, as Aziz had talked about, for the first 9 months of 2024, over 90% of our sales came from repeat customers. And this is part of a growing trend. In 2021, that number was 72%. In 2022, it was 76%. So we keep on growing that number to the point where now, over 90% of our first half sales for the first 9 months of the year are from repeat customers. And the great stat that we like to point out as well, that of those repeat customers, 70% of our top repeat customers have spent more money with us in 2024. So not only are they coming back, but we are getting a bigger share of the wallet size with them.
And Paul, I think you had us on fairly early, right after, as you know, we went public in October of 21. And then I think you had us on shortly after that, a few months, I want to say June or July of the following year. And at that time, what we said is, when we went public, less than 10% of our revenue was coming from ad-supported streaming. And after we went public, we said, look, where we're going to move is we're going to move into ad-supported streaming, where our core business was just simply display ads on mobile. And we said, we're going to shift this company from display ads on mobile into streaming. And today, this is proof positive. More than 70% of our revenue now comes from ad-supported streaming. And that is really what continues to grow. That's really where we saw the opportunity. We have unique data and insights and capability. And we said, this is what we're going to do in October 21. We went public in October, November 21. And this is where, November 21, is when we went public. And this is what we're going to be today. And that, sure enough, continues to be our driving mission, as Sajid just pointed out.
Yeah.
And other thing I want to add to this is, one of the things that, Paul, I know you're getting a lot of questions along this is like, great. Well, Sabio did great because it's a political year. And because of that, that really lifted, their business model. And certainly we benefited from that. But what I think some of our investors and some of the folks out in the ecosystem are forgetting is that in October of 23, we dealt with a auto worker strike. And one of our business models, one of our biggest categories is automotive. So we dealt with that in Q3 of 23. We also dealt with the writer strike, which affected some of our spend from likes of Amazon. And so the combination of those two elements brought down some of our, provided some, in addition to inflation that year, was challenging in our overall kind of core business model. And so while this year we benefited from political, our core business really recovered, automotive recovered, not as much as we like, but it definitely recovered from the negative number it was in Q3 of last year to now it was positive in Q3 this year. And our other core business is starting to take off. So that really is what I wanted to really convey to the marketplace, that while, last year was not an election year and certainly the numbers were down, it was really driven not only just because it was an election year, it was driven by other macro environment situations that are taking place. Sorry, I had to throw that in there.
Yeah, no, that's 100% correct, Aziz. I think that, as Aziz mentioned, we did benefit from political for sure. I know about 5 million of sales in Q3, but the fact is that our core business grew 28% outside of political. So our core business is even outpacing the broader CTV OTT ad-supported market as a whole. And as excited as we are about these top line results, and they are great. If you go over to the next slide, we're even more excited about what's happening on the bottom line and the operating leverage that we are seeing. I really should preface this by saying that we know how to run a profitable business. We were profitable in 2021, 22, in 2020 as well. 23, it was the lost years, as Aziz talked about, but in 2024, we're back to profitability. In fact, we were already profitable for the year for the first 9 months of 2024, with our historically profitable quarter to come in Q4. Looking at advertising as a whole, there is a bit of a seasonal nature to understand. About 70% of our sales are generated in the last half of the year, coinciding with the big seasonal events like Christmas, Thanksgiving, Halloween, etc. And in that vein, we have typically accrued losses in the first half of the year, and I'm more than made up for them in the profitable years in the second half of the year. Now, what's happening is that due to some cost-cutting measures that we put in place in late in 2023, $4 billion of cost cutting to be accurate, we are seeing those losses become a lot more shallow. In fact, in the first half of the year, we lost $2.2 million less than we did in the first half of 2023. And due to these cost reductions, because of the great third quarter we had, we were already profitable for the year by $1 million just going into Q4. And as we talked about before, Q4 is historically one of our most profitable quarters of the year. And so, if you look at the analyst estimates, they have us at around $3 million of a consensus of EBITDA for 2024. Our historical record before this was about 1.8 million. We have no issues with the analyst estimates whatsoever. We feel very, very good about it. So if you think about that, we're already going to be about a $4 million profitable company in Canadian dollar terms in 2024.
And while I don't want to look back too much, I do want to address Q3 one more time, and specifically 23, was the fact that we were growing very fast at a fast rate. And, as Paul, you might have seen with other companies who are new to public market ecosystem, sometimes you grow too fast and you don't have all the controls in place you need to have. And when you run into a challenging environment that we did, we had two options. Option number one was to raise capital and dilute our shareholders, which we didn't want to do. And option two was tighten our belts, position our company in a better place, and set us up for 24. And we did that. We made the hard decisions to part ways with people who didn't fit into our current business model. We made the cuts, and we told the marketplace, not only are we going to make the cuts in Q3 and Q4 of that year that we were in, but we're going to accelerate this business the following year. And we did it. And I think that's really what I want to convey to the market, that with so much inside ownership, 60% of the company is owned by insiders, including myself, who owns still 47% of the company. Our priorities are aligned with that of investors. And that's what made some of those decisions to part ways with some of our employees who've been here for a while was tough. But it was the right thing to do instead of diluting everyone along the way. It's because, and I think that, to Sajid's point, has really given us a better understanding of the levers we have to make sure we're a profitable company. And shame on us for not anticipating some of the challenges that we would have with a potential automotive strike. And that was on us. And we should have done better. And I think we learned a lot out of it. And we learned, what it means to really kind of fight through a challenging environment. And, all the while, and I'll add this to it, all the while at that same time, our credit facility was coming due right around that same time. So it's like we're dealing with this challenging Q3. We're dealing with the challenging, Q4. We ended up turning around and still get to profitability, and a credit line was coming due. And thanks to the masterful work of Sajid Premji, our CFO, and the leadership that him and his team were able to do and help us fine-tune the business model while getting us renewed on a new credit facility all at the same time. I mean, that really demonstrates the kind of chops we have as a company. And it was really one of those moments that was like, all right, let's do this. We can do this. And not only are we going to do this, we're going to accelerate doing it. So sorry, Sajid, I didn't mean to cut you off there, but.
Yeah, no, I think that that was, well put, Aziz. I think that, we're going to have the most profitable year in the history of our company. What makes us excited is that we've been able to grow this top line growth while keeping our operating structure kind of flat year over year. And so, and we've been able to do that while reallocating resources to the areas of growth that we see a lot of growth pillars ahead. We have a new programmatic offering on the pipe, a new performance offering as well. So we're still investing in growth. We know we're seeing a lot of growth pillars for 2025 and beyond, and we're approaching those pillars with a much more leaner operating infrastructure. And this kind of takes us to today. If you take a step back, we're a $50 million US sales company or close to that, based off the analyst estimates for this year. When you put that in Canadian dollar terms, that's close to 70 million Canadian. And so right now, if you look at our market capitalization, it's about 25 million Canadian, about 18 million US, enterprise value of about 21 million US. So you're seeing a huge discount on a sales basis, way less than 1x on a sales basis. And then if you look at it also on a profitability measure as well, with an estimate of close to 4 million Canadian of EBITDA this year, we're actually discounted compared to our peers on an EBITDA basis as well. So we believe this is a very compelling opportunity for us, for investors to join our company. And I think that, it's worth pointing out by this cap structure here that we're not a company that issues stock and dilutes our shareholders. That 55 million fully diluted shares that you see there is fairly flat since the end of 2022 after we made our last acquisition. I mean, that's, I think it was 54.3 million then, it's 55 million today. So we've been able to funnel this growth, right-size our ship, all the while not diluting our shareholder base. And as Aziz had mentioned, close to 60% of the company is held by insiders, with Aziz owning 47% of that float.
And it's just, we're excited about the year ahead. And I think as people are thinking about the way we're thinking about it, and the truth is, we felt really good about this year. We knew we did the right moves from a cost reduction perspective. And that didn't stop, by the way. We still have done cost fine-tuning across the way. But what we wanted to do was set us up for 25. We knew 24 was going to be good. We felt really good about what the momentum we're seeing. We saw the opportunities that political provided us. And so we said, all right, let's start building this for 25. And so we made changes in our management team that position us better, both from a sales perspective and a marketing perspective. We made changes we added some key people in a couple of new products we're launching, which is a performance product that is already showing some promise in some testing we have been doing today. And we said that on our call, that we have a performance product we've been doing testing on, showing promise there. And that product will allow us to go after more performance-related advertisers. Think of the likes of law firms who have some decent budgets to reach audiences, especially younger audiences, for all kinds of different elements here in the US. We have the launching of a streaming channel, which is going to be launched in January or February of next year, which we've talked about, which is Creator TV. It's the ability to leverage existing creator content, fine-tune that, and now launch it. We have launch of 2 channels that we're going to announce fairly soon, as I mentioned on the call, and that we're really going to finalize that and launch it in January, February of next year. And then we also have a programmatic, as Sajid mentioned, which is a new product that we haven't had access in terms of set of spending that takes place in that category, which we are already doing some testing in Q4 this year. And so we're seeing that accelerate. There's potential of accelerating that next year. So we weren't simply just looking at 24 as a big win and hurrah and congrats to us. It was like, great, we're going to do 24. Now we're going to demonstrate to the market how we can be even better in 25. And really, that's really what we're motivated by, is to demonstrate to the marketplace that this is not about political. This is about our core business executing at all levels. And we're excited about that. So Thank you for having us on. As you could tell, we always have a lot to say. So I'll shut up now and happy to take any questions, Paul.
No, very, very good. Thank you, guys. Yeah, reminder for everybody that's listening, if you've got a question you'd like me to ask the team here, just use the chat function and we can do that. I mean, clearly 2024 was a good year for you so far. You've got Q4 that is traditionally a strong quarter for you as well. You know, what challenges did you face this last year? It couldn't have been just a smooth ride all the way along, but what sort of kept you up at night a little bit?
Yeah, what first of all, the changes in the political, candidates and during the races, and I should just clarify this to your folks, is roughly 98% of our revenue comes from the US. We are a US company. We play in also the political space in the US, and now we're seeing obviously growth in our international markets, but that's really the core. And so with the changes in the candidates in the US races, obviously that was a little bit of a jarring time because we had a lot of great conversations and a lot of great momentum going into the cycle, and then the change up there. That was one aspect. The other aspect was the unknown of how inventory pricing would affect the situation and margins and how that would all come into play. And we literally put together a team anticipating that. Sorry, I'm turning off my phone. We put together a team to help us make sure we were maintaining our margins from an inventory perspective. And just so your audience knows, what we do is we basically we get inventory. We have direct inventory source. So let's say we have an app that's on Roku. If that app or that impression, that inventory, that ad spot fits into what we're looking for, we will grab that ad spot in real time. We will put one of our brand or political advertisers in that spot, and then we will provide, obviously, that cost to our advertiser or political client. And so we're making the difference, and that's why our margins are roughly around 60%. We have a 60% margin, gross margin business overall. And so when the political cycle comes around, that only impacts our political business, but impacts our core business. Because if you can't get the inventory at the right price and you didn't price it right, then you could get squeezed on the margin between the two. We literally anticipated all this, and I think you saw it in our margins in Q3. They were solid. We had solid margins in Q3. We anticipated that. So from a challenge perspective, it is that element. It's also the element of we see an incredible amount of growth. But we have to manage being profitable company while we're managing the growth. And what I mean by managing the growth is, our only limitation to growing is the number of sellers that we can hire that then go out to the marketplace, have the meetings, start setting up the revenue and doing that. But there's a roughly a 6 to 8 month lag between the time you hire a seller to when they start producing revenue. And so this is a balancing act we're constantly always involved with. It's the idea, including this year, which was like, we're doing well, great, let's hire some sellers to set us up for 25 to make sure we are now scaling this up in the right way. And that's really where the balancing act is. So that's what keeps us at night. We see a tremendous amount of growth ahead, but how do you balance that with the fundamental expectation of being a profitable company? That's
fair enough.
Resource allocation is obviously, as you know, as I've been told by many investors, is the most important aspect of any CEO, resource allocation. And that really is what keeps me up at night.
Yeah. No, very good. Very good. In that regard, then, do you foresee a need for capital? Is that, do you need capital to continue to grow?
We feel like we can do this organically, and we have all the tech we need. We believe that there's an opportunity, and certainly if the markets get back to where they're supposed to be and we're priced correctly, which we're far from, then certainly we will look at that option overall. But to take anything that would be close to a down round from where we came out as a public company does not make sense to us. And so our view is that let's get this stock where it belongs, and then we'll consider that. What we're more interested in is if there's any acquisition opportunities that fit into our model. Now, the good part about where we are technology-wise and the challenge where we are technology-wise, the good part is we have so much tech. There's not a whole lot out there that interests us. But the good part, about that is we're able to see the better margins because of that. So But we do think that, we're keeping an eye out for opportunities that could then make our company even, we can grow it even faster than where we're at today. And we're in our balance sheet, and, let, Sajid, please, chime in, but our balance sheet is probably going to be, is already and heading to being the best position it's been since, we've been pretty close since going out public for the first time. And we're excited about that. And that gives us a lot of maneuverability. Sajid, anything you want to add to that?
Yeah, I think that's well said, Aziz. I think that our balance sheet has a lot more stability than this time last year. We have a 3-year bank line with our line of credit right now, so we're in a much more stable position in that respect. And Aziz had talked about, M&A, might be a reason why we would consider a raise, but we have to find the right opportunity out there. But as far as raising money to run our business, that's not really a consideration. We have enough capital on hand and resources with our current infrastructure to be able to manage through our operating needs. And as I mentioned during the presentation, we don't take lightly the decision to issue capital, to issue stock. We have the same fully diluted count that we've had in the last couple of years. And so we're only going to be issuing stock if we really see a compelling opportunity for that.
And just to add to that, because our recurring business model continues to grow. So in 21, roughly it was about, in 22, it was a 72% repeat business. Then in 23, we went at 76%. Now we're at 90% recurring, right? And so it lends itself to continuing to kind of build on the momentum we're having with our existing clients, increase share of voice, and allowing us to extend our business model. And one of the things I mentioned, international, we literally launched that a year ago. That business is already profitable for us. It's growing at a fast rate, and we're adding more resources there, but it's already international. We see a big demand for our services, not just in the US, but internationally, specifically in Europe. And we see a lot of Europe, and we're going into the Middle East. And so we're seeing a lot of potential there. Incredible amount of potential.
When looking at your clients, do you guys have any kind of customer concentration? What's sort of the biggest client in terms of percentage of your business?
Well, we don't disclose, the actual client name just for confidentiality reasons. But if you kind of look across our spectrum of agencies and brands, there is no agency or brand that we deal with year to date that's been over 20% of our revenues.
Okay, gotcha. I can take one of the questions that came in here from Nolan. It says, how do we think about revenue for 2025? Do we strip out the 5 million from political campaign in the year and grow by 28%? Does it make sense to sort of normalize $11 million per quarter going forward?
I think it's just, I think one thing that's a bit of a wild card is that political doesn't end in 2024. We're still off election cycles in 2025 that we're going to be competing in, that we've already got commitments for to spend money with us for. And so there's going to be some political spending in 2025. And but there will be a drop off overall for the political category. But we believe that we have the growth pillars to offset that decline. As Aziz talked about with programmatic, with performance, we see not only the possibilities of offsetting that, but also growing beyond that. So,
so while we don't provide forward guidance, Nolan, if you took kind of the growth rate you're seeing within the last few quarters of ours and you extrapolate that out, I think it's suffice to say we feel pretty good about our core business, and then some additional additions added to our core from political next year.
Perfect. Take a little bit different turn here. Stocks performed fairly well over the last month or so. What's the general level of interest from investors? How has it changed, if at all, here in the last little while? What can you tell us about the inquiries from investors right now?
Well, what we set out to do, Paul, and I said, Sajid and I talked about it, and I said, look, starting in June of this year, I started the Aziz tour. And I think you saw me at some of the conferences. I was everywhere I could be. And my wife said, listen, I said, look, honey, I'm going to be traveling a lot. You might get to come with me some of these events. When she got to come, Vancouver is close enough. And the idea is, what we're finding is, as people get to know us and we demonstrate what we say, we said we were going to do, and we do it, it really ends up becoming a better situation. And everyone's starting to follow us more. And the reception we're getting, to answer your question, is very positive. the question I get asked a lot is, I don't get it. Why is your stock, if analyst coverage is right, and you're going to be at 70 million Canadian, why is your stock at 24 Canadian right now? And you're profitable. Why is that? And I say to them, you tell me. I could not imagine, Paul. I was sitting next to someone who's a retail investor. He saw my presentation in December of last year. Him and I happened to sit at a table at one of the events in February of this year. And he said, Aziz, I don't get it. I look at your presentations are solid. Your fundamentals look good. And you're telling me you're going to execute. What am I missing? I said, nothing. And so he bought in when it was 22 cents. And like you said, it's at 48 cents right now. And I'm going to say this to your crowd, to your following right now. Nothing is wrong. We are executing. Yeah, we made some mistakes in Q3 last year. We didn't anticipate like we should have. We got a little heavier than we should have. We've learned. And now we're just having fun executing. And there's nothing that is going to get in our way from doing that. So when I say that to investors, we had a meeting in Toronto just this week. And it was very positive. And I think people get it. And when they see us demonstrating that, as they will, as Sajid talked about, we feel good about where Q4 is. We feel good about where Q1 is. And one other thing I'd like to add, political did not kick in until Q3 of this year. And that really is where the political dollars kicked in. So if you think about our Q1 comps, no political there. In fact, we got hurt because political is coming in Q1, some of their brand advertisers moved out. Someone moved out in Q2. In Q3, they did move out because they were hurted about. So there was cutbacks that were connected to political advertising. And so the reception has been positive, and we point out to the fact that we're not concerned about our Q1 comps next year. We're not concerned about our Q2 comps. But listen, by the time we get to Q3, I think we will have demonstrated that we can grow this business outside of political and actually, even though we're going to have political next year as well.
Aziz, as investors watching the business right now, where do you think we should pay the most attention? What sort of metrics or maybe catalysts should we be watching out for?
We believe we're going to have an opportunity to announce the progress of some of our new products, or things that are involved with that. I think those will be catalysts. I think when we do our quarterly earnings reports to talk about once again the recurring element of our business, we're going to be able to hold strong and continue to build on a great base. So I think we're going to have, we're really excited about the new products that we've launched, and we're seeing some great, things come out of that. And we expect to be able to talk a little bit more about it in the next coming weeks and months.
Talking to these new products, do you expect them to have a material impact on revenues anytime soon, or is it, do we push that out a little bit?
No, it took us a year roughly to launch our international business. That is already showing benefits in a year time. As I mentioned, it's profitable. It's showing tremendous growth. These new products we've already have done some testing on. We do think that they will have an impact on 2025, and really going into 25, they'll have an impact, and then that impact will increase in 26, because as we get more opportunities, including our creator TV channel, that channel not only is going to be interesting in 25 and showing some real, and one of the ways to think about this is 40% of our cost comes in the form of inventory costs, right? Because we're grabbing inventory, we're placing it. Now, this is our own channel. So we're going to be able to get some additional margin off of selling our own inventory. And so that's also the benefit of this. Now, imagine this as we go into the midterm election cycle of 26. That's going to be another big election cycle in 26. So now this, as we continue growing this platform, that's going to be another bigger player in the 26 political races. Social influencers who are diverse nature, some of the biggest names you've heard of are going to be on our platform, and they're super excited. And the politicians who want to have them be associated with them are going to be excited. So, we're really excited about a few of these products. But yes, they will have material. They will have, material impact. We don't know to say for sure until we get into the year. And Sajid, how would you address that question?
Yeah, I think that it's what you said, Aziz. It's my feelings as well. Is that it's going to have it's going to make a material impact in 2025, but it's really going to have its larger benefits in 2026 and beyond. So I think that it will still have a meaningful contribution in 2025. It's definitely going to help to offset anything that goes away politically. And then in 2026, it's going to really help us form the base for where we want to be. And where do we want to be? We want to be a 100 million Canadian company by the end of 2026, and that's everyone's goal here.
And in off years, everyone should know that we grow roughly, Sajid, correct me on this, but I believe it's 30% in off years and then 80% in political years, 80% plus. So the reality is, last time I checked, a profitable company that's growing at 30% in non-political years is a pretty good deal overall. And that is no, that's no joke. And then you add to it, we're going to go into 26, which is going to be a great year overall. And we're going to, have a tremendous amount of growth in 2026. So, and that's right. And I hope your audience understands this is how we think. We're thinking a couple of years out overall and anticipated things and planning for that, because that's really what our business model is requiring us to do.
Well, we love to see 30% growth. That's for sure. Aziz, sort of last opportunity here, maybe a key takeaway, or did we miss anything? What do you want to make sure everybody walks away with today?
What you see is real, and that, the misprice of our stock is an opportunity, and that's really it. And I think if you got into the stock in February of this year, yes, you would have benefited from that, but it's not too late. And the reality is, look at where we were as a company when we came out. We were priced at $1.75 at a, roughly about a $70 million valuation. Today, we're at a $25 million valuation, despite the fact we have tripled, kind of the revenue that we've been. So close to doubled since we came out. And so I think the opportunity exists. It is a great opportunity. We're accelerating. The business is moving in the right direction, and to have the confidence in that, because we're going to have a fun year. And we had a great 24, but we're really excited about 25.
Well, listen, we look forward to seeing what 25 brings for you guys as well. We've been speaking with Aziz Rahimtoola, CEO of Sabio Holdings, and of course, CFO Sajid Premji as well. Guys, thanks for joining us today. We always look forward to chatting, and we certainly look forward to catching up with you guys at the next chance we get.
Thank you. Appreciate it, Paul.
Bye for now.